Major financial institutions are suddenly very eager to put their most exclusive, high-yield alternative assets directly into your retirement account. Historically, Wall Street firms strictly guard these lucrative private investments. They keep them locked away for their wealthiest clients and institutional partners, far out of reach from everyday retail investors. In August 2025, the Trump administration announced a new executive order, framed as a benevolent policy to democratize access to alternative assets for 401k investors. Which raises an obvious question. Why are the most ruthless investors on Earth suddenly lobbying Washington to share their most guarded, high-return investments with the general public? When billionaires abruptly rewrite the rules to grant everyday people access to their private portfolios, they are creating a retail audience to buy out their own high-risk positions. After the 2008 financial crash, regulators cracked down on the major banks. They enacted heavy rules that effectively stopped those institutions from making wildly risky loans to private companies. This animated flowchart shows what happened next. The lending didn't actually stop. Instead, the heavily regulated big banks safely passed their capital down to an intermediary layer, unregulated financial firms known as private credit. These shadow lenders then funneled that cash directly into high-risk companies. Because this workaround largely bypasses public reporting, this unregulated lending layer quietly swelled into a massive, highly opaque $3 trillion industry. But late in 2025 and early into 2026, the cracks started to show. Major bankruptcies began to strike the private credit market. Reacting to these early defaults, JP Morgan CEO Jamie Dimon pointed out a grim reality of finance. When you see one cockroach, there is almost certainly a swarm hiding out of sight. We are already seeing the swarm. Massive asset managers like BlackRock have been forced to limit investor withdrawals. The underlying money is tied up in illiquid loans, meaning the assets cannot be quickly converted into cash to pay back the investors. This withdrawal freeze creates a silent panic. It operates exactly like a bank run, trapping investors' capital inside failing loans the moment they realize the ship is sinking. The exact sector where these shadow loans are failing the fastest is the artificial intelligence and software industry. Many of the leading AI companies are surviving off a financial mirage. They cross-invest in each other, racking up trillions of dollars in obligations, despite generating very little actual revenue. This geometric scale illustrates just how concentrated the risk is. The combined market value of just 7 massive U.S. tech companies, the Magnificent Seven, now vastly outweighs the entire stock markets of Europe and China combined. This isolated tech explosion creates a powerful illusion. It heavily inflates U.S. GDP growth, making the overall economy look incredibly robust on paper. However, if you step outside of that Silicon Valley bubble, the metrics shift. Roughly 80% of the U.S. population is actively living through localized recession conditions. Add to this a final external pressure point. The escalating U.S.-Israeli war with Iran has triggered a historic global oil shock, severely disrupting supply chains and spiking domestic inflation. Between the lack of AI revenue, a localized recession, and a global energy crisis, these high-risk tech borrowers are facing a collapse in their ability to service these shadow loans. Contagion follows a highly predictable path. When the tech bubble pops, those unregulated private credit firms will go bankrupt, and when they fold, they will default on the massive loans they took from the heavily regulated Wall Street megabanks. Moody's estimates that major U.S. banks are still directly exposed to nearly $300 billion in these toxic private credit loans. Lloyd Blankfein, the former Goldman Sachs CEO who navigated the 2008 crash, explicitly warned that the market is due for a systemic reckoning, specifically pointing to opaque, illiquid credit assets. Which brings us back to the White House executive order. The push to open 401ks to these alternative assets was heavily lobbied by major donors like Stephen Schwarzman, CEO of Blackstone, a firm with massive exposure to the private credit market. The mechanics of the grift require an exit strategy. The sophisticated smart money on Wall Street sees the crash brewing. To get out, they need an ocean of unsophisticated retail capital to buy these toxic loans off their hands before the music completely stops. Through targeted policy changes and hidden lobbying, the systemic risk generated on Wall Street is being deliberately and quietly transferred directly into your retirement account.